In this edition of the Property Imperative Weekly, we answer some of the questions that we've received over our social media channels. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. There's not been much on the news front this week because it's still in silly season. So today we're going to answer some of the questions that we've received recently over our social media channels. This is a less formal presentation than normal, but we hope you find it interesting, and if you like this format, then leave a comment below and perhaps we'll do more of it later on. So the first question we've received a number of times is how we define mortgage stress. It's a very good question because we report on this each month. And in fact, the latest report came out just this last week and it was up again. We got a lot of press coverage and there's a separate video available on that. But mortgage stress is defined not as a set percentage of income going on the mortgage, say 30%. That's what many other commentators use. But we look at real cash flows. So we measure the amount of income coming into a household. We measure the total costs going out. And essentially, if once you've taken account of mortgage repayments, there's nothing left in the bank, as it were, they are in mortgage stress. And if they're severely underwater, then they're in severe stress, and households who are in severe stress are much more likely to get into difficulty down the track. So mortgage stress, when we define it, is cash flow based, and it's looking at real household income and expenditure, not a set ratio. The second question relates to the parallels between the Australian mortgage market here now and what happened in the US in 2005. We've been running a thesis for some little time that there are some strong parallels between these two situations, because in 2005 in the US there was significant lending to households that really shouldn't have had the mortgages. There was also growth in their mortgage books. And of course, there was quite a lot of financial engineering going on and securitization and those sorts of things. Then what happened in 2005 and 2006 was that mortgage rates started to rise in the US, and that's when things really started to go pear-shaped, and effectively a lot of households who had little wriggle room got into great difficulty as interest rates rose, to the point where the defaults rose significantly. And as we went into 2007, 2008, around 15 to 20% of households in the US were underwater and in difficulty with their mortgages, and that created then the cascading effect. Because the securitization industry fell apart, that impacted the balance sheets of the banks, and the rest is history. So the question is, how does that compare with what's happened here in Australia? Well, there's a few things the same and a few things different. The first thing to say about Australia is that there is a very high level of household debt. In fact, the ratios here, comparing them to the US, are much, much higher. So we have more households with more debt. We have the same low interest rate scenario. So interest rates in Australia are at an all-time low at the moment. The expectation is, though, that those rates will rise over time. The question is how quickly. We also have got evidence of underwriting standards in Australia being relatively loose. And as a result of that, we've got the situation where households today have mortgages that they probably wouldn't now get if they were applying today. And this is a backlog that we've got not just from the last few months, but over 4 to 5 to 6 years. So the banks in Australia are now making a much more rigorous assessment of the costs of living that households have and the expenses that they have. And they also are likely to look harder at income as well. So today, it's harder to get a mortgage. Plus the fact that now the loan-to-value ratios that the banks are prepared to lend at are falling, as well as the proportion of loans that are going to be interest-only are also reducing as well. All of those things together make it tougher to get a mortgage. But we've got this overhang because of the very loose situation that we had for a good number of years. And the regulators really did very little to tackle this until very late to the piece. Now, if interest rates do start to rise, then we're going to see the pain that we're seeing through the mortgage stress analysis coming through into high levels of default. And in a sort of scary scenario, we could see essentially the number of households at risk doubling over the next couple of years. That would be very difficult if that was the case. Now, maybe rates won't rise as quickly and maybe incomes will start to rise. That's another point to make, of course, because in the US, incomes actually were growing quite quickly at the same time as home prices were rising, at the same time as the mortgage bonanza was happening. Here, we've now got the situation where incomes are flat and indeed in real terms falling. So what that means is that many households have no way out. So if interest rates start to rise, if incomes remain flat, all of those things suggest to me that we've got strong parallels between the US market in 2005 and where we are now here in Australia. There is a difference. The banks here have higher capital ratios thanks to the lifting of standards across the board. So they have more ability to handle some higher risk of loss. But generally the view we have is that the banks are understating and underestimating the total risks in their portfolios currently, and down the track we think those risks will continue to rise. So the next question that we're asked quite often is, do we think the underwriting standards for mortgages will get tougher moving forward? As I say, they've already improved or lifted their lending standards, most of the banks, but it's still, I think, a question as to whether it's tight enough. We're still seeing a number of loans, particularly for first-time buyers, where the income multiple is 5 or 6 or 7 times. And we're also seeing situations where more than 50% of income is assumed to go to repay the mortgages. Those are scary numbers. And my own view is that there are some significant steps that need to be taken to further tighten underwriting standards. In addition, we're also seeing more non-banks lending now. So in fact, the most recent data we've seen is that the non-bank sector is growing faster than the bank sector. Now, the non-bank sector is not regulated in the same way at the moment, and so they're much freer in terms of their lending. We think there's a strong case now to tighten underwriting standards in the non-bank sector to more mirror what's happening in the mainstream market. And the next question we often are asked is, what do we think the likely trajectory of interest rates and home prices is likely to be? Well, firstly, on interest rates, we think that interest rates will rise. There's already evidence coming through from the US. The most recent employment data is strong. We expect the US Fed to lift rates further over the next 12 to 18 months, and the funding costs in the interbank markets will rise. That will put immediate pressure on the banks here, and it's very likely that therefore they will have to lift their rates simply because a lot of the funding for mortgages comes from the overseas markets. The Reserve Bank probably won't do much for a few months because essentially the banks themselves have been lifting rates and trimming the market momentum as a result of that. But at some point, it is quite likely that the Reserve Bank will indeed lift interest rates, probably later in 2018. Even a small rise in rates, even 0.5 or 0.25%, would be sufficient to tip a significant number of households over the edge. And so they're going to be very conservative in their approach to lifting interest rates. So it's quite likely that by the end of 2018 and 2019, mortgage rates will be higher than they are now. So then the question is, what happens to home prices? Well, we've already seen evidence recently of home prices beginning to slide, particularly in the eastern states, Sydney, of course, leading the way. There's also some evidence now in some parts of Melbourne and in some other places too. Now, in some of the smaller states, there is still positive momentum, for example, in Tasmania and South Australia. But it's the major markets that we need to be concerned about. The views that we have now are that over the next few months, we will continue to see home prices slide lower. And this is simply because of the supply-demand equilibrium changing. Around 35% of all mortgages relate to investment properties, but investors now are getting much more coy about coming back into the market. Our latest surveys show that more investors now are concerned about whether there will be future capital growth in their properties. They're also seeing net rental incomes still very static or indeed falling in real terms. And so the economic proposition of investment property is changing quite considerably. So firstly, new property investors are unlikely to come into the market. Even if they try to come into the market, their ability to get mortgages is also being constrained by the changes in lending policy. So investors will not support the property market over the next 2 to 3 years. We also see first-time buyers who are active in the market at the moment. There are some amazing attractor rates for first-time buyers, but first-time buyers are required to put a larger deposit up now. And whilst there are some tricky alternatives in terms of the bank and mum and dad or deeply discounted rates to start with, all of these things create economic issues down the track. And we're not convinced that it's sufficient to enable a large number of first-time buyers to get into the market at the moment. We also think that first-time buyers should do their own calculations based on where their finances are, because the bank is making an estimation of risk from risk of loss to the bank, not impacts to specific householders. So our recommendation is, if you're a first-time buyer, think of getting into the market now, do your calculations at 3% higher than current rates, because that will give you a flavour of what you can really afford. Don't just grab the loan because essentially the bank says you can have it. So with investors effectively backing off, first-time buyers there and a little bit active, then the question is, who else is buying? Well, there are about 1 million down traders in our segmentation models. Now, down traders are people who have a larger property and are looking to sell and to release equity and to move into a smaller place. A lot of them are actually trying to sell at the moment because they think that this is pretty much the peak. And so the question is, are there enough people out there willing to buy those properties that are on the market? And the answer is no. There are not enough people who are looking to trade up, or indeed foreign buyers to come into the market to be able to sweep up the properties that are actually coming onto the market. And so in February and March, we expect to see a considerable rise in the stock of properties for sale. So you put all that together, supply and demand, and essentially it suggests to me that things have changed. We're going to see interest rates probably moving up later in the year, as we discussed. All of these things together mean that home prices are likely to drift lower. They will drift lower certainly in Sydney. We think Melbourne is about 6 months behind Sydney, but they will also trend lower there. There will still be some activity in some of the smaller markets, but we think that will also ease. And if underwriting standards are tightened later in the year as well, then all of these things come together. So our base case for this year is that prices will be 10% lower by the end of the year. It could be a lot worse than that. It could be a little better than that. But it's certainly the case that we don't see any reason why home prices should rise from this point. And just because we've seen very strong growth over many years, that doesn't mean that home prices can only go up. Remember that in the US and in the UK, we saw home prices sliding 35% off their tops. And interestingly, if you do the basic economic modelling, as we've done, we think that home prices in Australia are at least 30% valued over where they should be based on fundamentals. Now, okay, there is migration, and migration will sweep up a little bit of that. And particularly in the major centres of Sydney and Melbourne, we're seeing a lot of people coming in from overseas, some of whom can buy. The downside, of course, of migration is that the major centres get ever more populated, means that there's more traffic on the roads, and it's just getting more and more crowded. We haven't really done enough planning as a nation, I think, to allow this big Australia policy to continue. And in fact, the view I would have is that if we really want sensible strategies, we should start with looking at how to actually manage migration more effectively. The bottom line is this. We are at a significant turning point in the property market. We think it will definitely go lower over this next 12 months. We think that more households will get into difficulty and underwriting standards will continue to get tighter. So if you're looking to buy into the market now, go careful. If you're in the market and you're struggling with mortgage stress and how to balance the books, our advice is simple. Start with building a household budget, because about half of the households that we interview us for our surveys don't have a full household budget. So they actually don't know what they're actually bringing in each month, and they don't know what they're paying out each month. Build a budget. Then start prioritising and selecting what's important, because there are always ways to hunker down. So the real question is, will incomes begin to rise? Because if they do, then some of the things that we've been discussing today perhaps won't happen. But there is little evidence really to explain why and how incomes should start to rise. So we think that people will still be struggling to see incomes growing over the next little while, and therefore that's why we're rather gloomy on the property market and on the mortgage market. So that's the end of this rather informal edition of the Property Imperative Weekly. Thank you very much for watching, and do check back again next week when perhaps we'll be back to our more normal formal structure where we discuss the most recent news from the finance and property sector. If you found this useful, do leave a comment below, do subscribe to receive the latest updates, and check back again next week. I'm Martin North from Digital Finance Analytics. Many thanks for watching.